Today is May 30th. I'm Chris Nebenzahl, joined by Jay Denton. Jay, what are we seeing in the market this week?
Chris, we're going to talk a little bit about single family. Some metrics have come out over the last week or so. Single family sales are down a bit, just our take and maybe some impact that will have. And maybe it'll have a little bit of impact on traffic. I don't know. We're going to dig into the R stats related to traffic, which is one of those leading indicators that we really focus on. And then we'll wrap up and hear your plans for what you're going to do for the summer, whether it's for clients or personal or whichever way you would like to take it. So let's go ahead and get it kicked off.
Sounds good. All right. Well, as you mentioned, existing home sales were released last week. They were lighter than expected, down about 1.9%, both on a month over month and year over year basis. Really, the story there is kind of persistently high mortgage rates. Rates had jumped as high as 8% last fall. They were trending downward to begin the year, as many economists thought that the Fed would cut interest rates, that the housing market would get a boost off of that. But obviously, we have yet to see that cut in interest rates. And so mortgage rates have stayed persistently high. Interestingly enough, home prices are also increasing in price. And so we saw about a 5.7% increase in the median home price in April. Now, you take high interest rates and you combine that with rising prices, that's going to price even more would-be home buyers out of the market. So that's really the reason behind this slow shrinking of the home sale data. I would expect home sales to rebound a little bit once those mortgage rates stabilize and come down. But to be honest with you, we haven't really seen that, and in fact, we are looking at fewer and fewer rate cuts this year. So, I think the housing market will be strong, but on the flip side, this is good news for the rental housing industry. Demand should benefit from the slowdown on the for sale side. Jay, I know you were recently in the for sale home market. Tell me a little bit about kind of where your head was at when you decided to buy a home, and specifically on the mortgage rate side.
Yeah, I'll tell you a lot of what I've read that I think people summarize appropriately is, well, who is buying houses now? And part of it gets back to life happens. For one reason or another, someone decides that they're going to move, whether to another city or just relocate within their own kind of metropolitan area, which is what I did. Sometimes for schools, there can be a variety of reasons. So there are going to be buyers out there, even with the rates higher, and the longer they stay higher, the more people get a bit used to it. I'll tell you, so I sold a house about this time last year. My mortgage rate was something like 2.9%. So when it rolled around to February and I'm closing on a house at 6.6, I just didn't know how to take it, honestly. It was, kind of a hard thing to adjust to. But now, since then, right after I closed on my house, rates jumped back up around or above 7%. They were as high as 7.2% earlier in May. They're maybe just around 7 right now. I think I saw the latest Freddie Mac number was 6.9 something, but made me feel a whole lot better about my 6.6. I'm like pretty excited about that at this point. But even though I think what's interesting in the same report that you're mentioning, so mortgage rates are up generally from where they've been. Now, if we go back to last year, they were even higher. There was a point where they got to about 7.8%, I believe. So down from maybe the peak, but up from earlier this year, up from expectations. We are starting to see, though, in the same report that more sellers are starting to list their house. So that number is inching up, which is, I think, going to be an overall good thing. We just need more volume flowing through. And I'm talking about for broader economic reasons, not specifically to multifamily, because to your point, and maybe it's only like helpful on the margins, but with record supply still persisting, it's still really important that any help we get for the multifamily side is great. But what I worry about for that whole industry and supporting industries is this is the prime time to be listing and buying homes. And if that number doesn't start increasing soon, much like in the apartment industry, you kind of miss the window for the year. And now it's more of a 2025 story. So we'll be watching that. As it relates to, I mentioned back to multifamily, not just multifamily, like who's going to occupy the homes, but also we know that job growth is very important to the multifamily industry. The more jobs that get created, typically more apartment units get absorbed. if we look specifically at not just housing, but some industries that support housing that have also been impacted by the slowdown in home sales, take furniture stores. Furniture stores have 40,000 fewer employees today than they did 2 years ago, right around the time or before the time that we really started seeing rates start to get hiked aggressively. They're also down 70,000 from before the pre-pandemic, so there's still a little bit of a gap there as well. That it took longer for them to come back, but they were starting to improve based on home sales, and then decelerated the last couple of years. If you're familiar with a Lowe's or a Home Depot, the BLS categorizes those as they're called building material, garden equipment, and supply dealers. Those types of stores from their post-pandemic peak. So remember the days when everyone was staying home, renovating their homes because we had to figure out to make our backgrounds look good, and you're bored, so you're doing a lot of gardening outside, and so they got a huge influx of demand for those types of stores. Those types of businesses, that they have 76,000 fewer employees today than what they did just a few years ago. And so, the housing market, obviously, when you think about it, you think about lenders and realtors and so on. It's having a bit broader effect than that. Just one more quick stat. I mentioned those two are down, but if you look at overall retail is up 185,000 jobs from 2 years ago. So it's not just a retail thing. It's those specific types of jobs and industries that also support housing.
Yeah, that's a great point. And you mentioned kind of the residents, be it a tenant or an owner, their bottom line means a lot, right? And one of the statistics we've talked a lot about is a few years ago when rates were low, as you mentioned, the average $500,000 home would cost about 2,300 in terms of mortgage, principal, and interest and everything. That has jumped to about 3,300, so about $1,000 difference just with rates going up as they are. Let alone the fact that prices are now going up as well. That takes a huge hit to kind of the everyday income and the everyday back pocket of Americans. So again, we mentioned that feeds a lot of apartment demand. Jay, what have we been seeing in traffic? And tell me a little bit about how we might see that demand quickly play out in our data and some of the leading indicators.
Yeah, one more quick comment that kind of bridges those two. You mentioned that this should be to some benefit helpful to multifamily. In the Wall Street Journal article that summarized a lot of what we just talked about, there was a line in there, I think, that said many would-be buyers are staying put, and staying put either in a single family rental, a single family owned home, or something in multifamily. And so with multifamily, if they're staying put, we would expect occupancy rates to really start to maybe improve, and we're not necessarily seeing that. And so when we try to diagnose, well, why? Like, what happens before occupancy moves one way or another? And that's where we focus on some of the leading indicators that we track beyond just the outputs of, say, rent growth and occupancy and revenue growth, or what are some precursors to those? So occupancy rates, before you occupy the unit, you lease the unit. So we track leases, but even before that, before someone leases, they're often going to tour the property. And so we monitor traffic counts. And this is something throughout the year that you and I, as we've done our presentations, whether it's kind of broad overall market presentations or very specific client ones when we're focused on certain markets, we've been seeing pretty much across the board, maybe not every single location, but at least at the US average, traffic counts under what they've been the last few years. And not just the peak years, but blending in the last several years, so you get a balance of really strong periods and those that are a little bit more moderate. And I think the numbers you've been putting out, it's something like maybe one fewer tour per week, which might not sound like a lot. When you stack that up over a full year, it has a meaningful impact. And so, I think that's the thing that we've really been making sure we focus in on. And we've been having these conversations with clients that traffic counts are lower. So you're going to have to figure out something else to keep your leases up and your occupancy rate at least steady from where it was a year ago. And often, obviously, people are trying to boost those occupancy rates.
Yeah, that's absolutely right. Absolutely right. And overall, we have seen traffic weaker than it was last year at the national level. But there are some markets that are really excelling in traffic. And when I look at the numbers, I kind of broke the statistics down in a couple buckets. One was the year over year numbers. what markets are improving from a traffic perspective compared to this time last year. Year to date is a metric I like to look at as well, because it kind of shows um, not only the leasing season but leading up to the leasing season, which markets have been strong. And then I looked at the data kind of specifically on the leasing season. I looked at the beginning of March to now and what markets have seen the largest increase in traffic. So, kind of starting with that leasing season, it's interesting to see there are a lot of smaller markets that have been outperforming, and I would consider them satellite markets. So, a place like Colorado Springs, a place like Reno, Nevada, a place like Virginia Beach. All of these are in relatively close proximity to a big market, Denver, San Francisco, and DC. Not right next to it, of course, but a satellite to that market, and really, really strong growth. You see, Colorado Springs has added about 2.5 tours per property from the beginning of March. Colorado Springs is a market that has been hit pretty hard by new supply. Same thing with Reno, almost 2 tours per property per week compared to the beginning of March. Reno is an interesting one, more than 3 tours year to date they've added. And all three of these markets have average touring, average traffic above the national average as well. So it's not like we're, still struggling. Interestingly enough, a market like New York, their traffic is slowly starting to pick up, but it's still well below kind of the national average. I think about 6.5 tours per property in New York. So some of these smaller markets, again, we've talked a lot about traffic being the strongest, demand being the strongest in the Sun Belt. And obviously, that's where supply is hitting as well. But we see places like Raleigh, like Tampa, like Orlando, Miami. All of these markets have total traffic well above 10 tours per property. So there are kind of two ways of breaking down traffic, right? Who's seen the biggest growth? And obviously, we want to look at kind of year over year and month over month, year to date changes. That's important too. But you can't ignore the absolute traffic, the absolute number of people coming into a property, touring on a weekly basis. That's what's driving kind of overall total demand. And so we've talked a lot about Raleigh and Tampa being oversaturated markets, oversupplied markets, and they are kind of the ultimate performance metrics, revenue, rent growth. Those metrics are still struggling, but it's really good to see the growth, both in the short term. Again, that kind of March to now, or the past 3 months, the leasing season growth in traffic. Raleigh, a tour and a half per property. Tampa, a tour and a half per property. Not only are they growing, but they're among the most trafficked markets in the country, well into double digits on the number of tours per property. So,
Yeah, and
Jay, go ahead.
yeah, I was going to mention another thing that, as you and I have discussed this with clients, it's at the national average. You just highlighted some great situations where traffic is up or it's improving, which is good to see. But a national average, as we mentioned, it is down about a tour per property per month. Which again, if you take that over a whole year, it's like missing a whole month or more's worth of traffic, depending on how big the property is and what's normal for the market. But that's significant. I think the good news that we've seen, especially with all the supply coming in, is occupancy rates are fairly stable. Now, we would be preferring that they grow during this point more significantly than they have been, but things have at least been stable. And so when we step back and we say, well, how is it that you have traffic's down, leases are down just a little bit. So leases, so it seems like the conversion ratio is a little bit better, but leases are also still down. New leases are down just a little bit from where they were before. And it just points to, and I've seen this come out with whether it's publicly traded companies or some others that have talked about it, that retention is up, which is also great. And so I'm actually going to be on a webinar next week. It's for a company called Smart Rent, and they help provide smart home technology for apartments. And I think what's interesting is, part of the discussion that we're going to have is how do you think about, with traffic down, how do you either boost traffic or make sure you keep as many renewals as possible? And are there ways with the types of amenities you have, how you market those amenities? Because it's not just a price situation. There are other things out there, and especially with the competition with new supply, just how important it is to really focus to keep traffic even just where it is. But really the preference would be to boost it, because occupancy rates, as we've talked about a lot, are still off from what most operators would prefer.
Yeah, that's absolutely right. And for any of you who have read our Rayot report, we've talked a lot about renewals, retention, and those metrics being hugely important this year. Again, kind of going back to the data, it's not all kind of sunshine and roses for a lot of these markets. Looking at the annual data, big markets like Dallas traffic is down about 2 tours per property compared to last year. Chicago, Boston, both down a tour and a half per property per week from this time last year. So again, Jay, to your point, it's how can property operators incentivize, attract people not only to come in and tour, but retain those tenants, renew those leases. Likely, as our forecasts are looking, likely for another 12 to 18 months before things really start to pick up again. I know we briefly talked about the forecast last week. It looks like the real pickup in performance is going to be kind of late 2025, not even early 2025. So we're still a good year plus away from kind of the strong bounce back, both in rent and occupancy as well. I would imagine all the way down kind of into the traffic numbers as well. So Jay, any final comments on kind of how our listeners can look at traffic, can use traffic, what some of the value of those leading indicators are?
Yeah, I think it just gets back to basic business fundamentals of, what you really want to do is not focus on just the outputs. You got to step back as far as you can in the equation. Like in a sales organization, you shouldn't just be focused on deals closed. You go all the way back to number of demos, or before that, new contacts in the pipeline. Like, just dial it as far back as you can, because that's usually where you're going to be able to diagnose the problem better along the way. Of, is it, I would say, even within our ecosystem, our data. Part of what I love is when you think about traffic and you're an individual property. So as an individual property, if my traffic's down, then maybe, there are a variety of things that could be happening. It could be my marketing. It could be my landscaping outside is not good enough. My rent's too high, or, whatever it is. When you then start to look at a whole comp set or a submarket or a market or the US, and you see more often than not, traffic's down everywhere, then you start to realize there are more levers you might need to pull to get it back to where it needs to be. So one, just as often as you can in whatever line of business you are, try to bring the indicators you're looking at as far, as leading indicators as possible, not just the outcomes, but then to be able to observe, is it just you, or is it a broader symptom in the market? Because then that starts to open up more possibilities for how you need to react to get it back on track.
Absolutely. So we've talked a lot about traffic today. We had Memorial Day last weekend. Usually the road traffic picks up around now and through the rest of the summer. So that's a terrible transition. I realize that. But Jay, what are you looking forward to now that the summer has officially begun? What are you going to be up to with Radix and perhaps on the personal side as well?
Yeah, sure. I don't have a ton planned this summer compared to normal. I think you and I have been so busy traveling and other things. I'm just now starting to get to even contemplate that. But I know both of us will be at NAA in Philadelphia here in a few weeks. Looking forward to a lot of fun stuff there. We've got a lot of people registered for the happy hour that we're having. You and I are going to be giving some market updates. I'm sure a lot of other conversations. Other than that, I'm still figuring it out. I think the thing I'm looking forward to is all the market updates you're going to be doing for Radix. Maybe if you can give people a preview, because, we haven't gone real deep in these podcasts, at least so far. I'm sure we will at some point, but we tend to stay a little bit more macro level. So, if somebody is two questions for you, and then maybe the third on what else do you have going on for the summer. So first would be, which markets are you getting ready to cover? And then second would be, what's some of the depth that you would provide in those updates?
Yeah, absolutely. So we're about to launch the second round of our Market Spotlight webinar series. So we'll be starting with Phoenix this week. Then we'll be covering the three major markets in the Texas Triangle: Houston, Austin, and Dallas after that. We'll take a break for NAA, as you mentioned, at the end of June. And then we'll fire up the Market Spotlight series again in early July, likely focusing on the Southeast: Atlanta, Raleigh, Charlotte, and covering some of the big markets in the Southeast. So If you're interested in those, please check them out at radix.com and sign up for the webinars. But we'll also be doing a lot of client market updates. So for any clients that are listening, if you're interested in taking a deeper dive into your MSAs, specifically talking about kind of what submarkets are outperforming, we do a lot of analysis on urban versus suburban submarkets, especially in some of these faster growing markets in the Southeast, Texas, and the Southwest. We see a pretty large bifurcation between urban and suburban performance. So happy to kind of dive in there. And then we talk a lot about the relationship between our metrics. We look at new supply pipelines. We look at the traffic and leasing activity. We see how that has an impact on occupancy, on revenue per available unit, on net effective rent growth. So happy to do a lot of those deep dives with our clients, as well as I mentioned those market spotlight webinars that are coming up and available to the public. So we'll be doing a lot of market talk this summer. Jay, I imagine you'll be on many of those as well. We'll keep these podcasts going, so it'll be I will say it'll be a very virtual summer. Looking forward to that. Looking forward to talking and connecting with a lot of our clients. Also, really looking forward to NAA. Philly is a great market to be in. Hopefully, it's not too hot at the end of June, but really looking forward to Philadelphia and to NAA. Should be a great conference.
But it seems like you're getting all the really tough markets out of the way. So it's like all the ones getting hit with the supply is just get those out of the way, and then in the fall you can talk about happier stuff.
Exactly, and hopefully there will be some bright spots. I think there are. Again, we talked about demand and traffic. Places like Texas have always dominated demand. We talked about population growth on this podcast a few weeks ago. Texas is getting hit hard, and no doubt about that. But again, the demand is there. Same with the Southeast. So yeah, looking forward to diving into a lot of those market spotlights.
And I'm sure you'll cover, another obviously bright spot is in the look ahead. That one, you can cover what our forecasts are showing for once this supply wave clears, because that's the good news, I think, for the people in the market, that for most of these places, there is a light at the end of the tunnel and it's getting closer. And so you can give a little bit more insight for each one of those markets, I'm sure, of how that'll look.
Absolutely. So again, feel free to go to radix.com and sign up for those webinars if you'd like. Jay, any final thoughts before we sign off for today's pod?
No, just fingers crossed. I've got 2 Dallas teams deep into the playoffs right now, so fingers crossed they make it to the next round.
Dallas is the hot spot for the sports world these days. So with that, we'll sign off. One thing that would greatly help Jay and I and our podcast, if you could review, comment, rate on Apple Podcasts and Spotify, whatever platform you're listening to. Tell us what you like. Tell us what you don't like. Tell us what you'd like to hear more of. That helps us out a lot as we continue to build out the Radix Review, Multifamily Trends Explained. And thanks to everyone for listening. We'll talk to you again next week.